Over at Goldman's 36th Annual Financial Services Conference underway in New York City. We've seen great content from there over the past day or so. Leslie Picker is there now, joined exclusively by Blackstone President and COO Jonathan Gray. Perfect timing as we're about to hear from the Fed. Leslie, over to you.
Perfect timing indeed, Kelly. John, thank you so much for joining us. As Kelly mentioned, it's a great day to have you and get your perspective really on the macro. I'm just curious what you're seeing across the portfolio in terms of distress versus risk appetite. And what does that indicate to you about the need for additional rate cuts in 2026?
Well, Leslie, it's great to be with you. I would say we're seeing a pretty good macro environment. When we look at our companies in the third quarter, their revenue growth in private equity was up 9%. This AI CapEx boom has really fueled a lot of business activity, particularly in the United States. Where we see a little bit of weakness is on the consumer side, sort of the middle to lower. If you look at water parks and theme parks, hotels, you do see some weakness there. The labor market has softened a bit. So when we talk to our CEOs, they say it's much easier to hire today than it was 3 years ago. And wage rates have gone from sort of low fours to call it 3% on an hourly basis in the U.S. And I think that softening of the labor market, given the Fed's dual mandate, will help them cut rates. I'd also say on the rental housing front, which is a big component of CPI, the data lags, and what we see in our portfolio is much lower inflation there as well. So I think the overall picture is pretty good resilience, some softening on the consumer side, a bit of weakness on the labor side, some slower inflation numbers. That should allow the Fed to cut rates. That's good for the economy. Ultimately, it's certainly good for our business.
So it will allow the Fed to cut rates. The market is expecting a 25 basis point cut here in just a few minutes. What about 2026? Do you think 25 basis points is enough given what you're seeing? Or do you think the portfolio could use potentially even more easing in order to prevent some of those concerns from getting out of control?
Yeah, I would say it's really about the U.S. economy and the labor market. And I think they're likely to cut rates because there are parts of the economy that are more tied to capital intensity, housing in particular, commercial real estate, construction, some of those areas that, lower rates would help. Certainly they would help consumers, they'd help companies. Again, I think the good news is the inflation data with a lag here will be supportive of those cuts. And so as investors, an environment with a pretty resilient economy, lowering cost of capital, and then this big potential productivity boom coming from AI, that's not a bad combination. And that's why you see us investing so much capital.